Mixing trading styles feels harmless at first. You take a quick scalp, then you hold the next trade longer, and you tell yourself you are being flexible. But what is really happening is that your rules are changing in real time, and that destroys consistency before you even notice it. Welcome back to the ComLucro channel. In this video, we will break down the most common mistakes traders make when they mix trading styles, and why this creates hesitation, emotional pressure, and unstable results. You will learn how mixing styles breaks execution and routine, how it damages confidence over time, and how to simplify your approach so you can build real consistency. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. The first place where mixing trading styles causes problems is execution. The trader is no longer executing one clear type of decision. Each trade is handled differently, even when the setup looks similar. One trade is entered quickly and managed aggressively, while the next is entered slowly and managed cautiously. This inconsistency is not random. It comes from switching between different trading styles without realizing it. Timing is another major issue. Scalping requires decisions made in seconds, while swing trading allows time to wait and think. When traders mix these styles, reaction speed becomes unreliable. Sometimes they hesitate when speed is required. Other times, they rush decisions that require patience. The problem is not a lack of skill, but a misalignment between decision speed and the chosen style. Trade management is where this confusion becomes even more damaging. A trader may enter based on a short-term setup, but once in the trade, they begin managing it using higher time frame logic. Stops are widened, targets are moved, and the original plan slowly disappears. At that point, the trade is no longer defined by a strategy, but by emotion. Routine also breaks down when styles are mixed. Each trading style requires a specific daily structure. Scalping needs short, intense focus. Day trading requires defined sessions. Swing trading demands distance from the screen. When styles are mixed, there is no clear start or end to the trading day, and performance becomes impossible to measure consistently. One of the most common mistakes traders make is scalping while expecting swing results. The entry is taken on a very low time frame, but emotionally, the trader wants price to run far. This creates hesitation at exits, greed after small wins, and frustration when price pulls back. Scalping is built around quick reactions and predefined exits. When traders hold longer hoping for more, they stop trading the setup and start trading hope. The trade may begin correctly, but it ends incorrectly because expectations are misplaced. Another frequent mistake is turning day trades into longer-term positions. This usually happens when price moves against the trader. Instead of accepting an intraday loss, the trader starts thinking in higher time frames to justify staying in the trade. This behavior is not patience. It is avoidance. A day trade is designed to be resolved within the session. Once the session logic is broken, the original plan no longer exists. Risk increases without intention, and emotional pressure grows. A third mistake is using the same risk model across all trading styles. Traders often apply identical stop sizes, position sizing, or risk percentages regardless of time frame. This creates imbalance and distorts trade outcomes. Scalping requires tighter stops and higher frequency. Swing trading requires wider stops and fewer trades. When the same rules are applied to both, trades feel either too tight or too loose. Losses feel random and wins feel inconsistent. Another subtle but destructive mistake is analyzing with one style and executing with another. A trader may analyze structure on a higher time frame, but manage the trade emotionally on a very low time frame. This leads to premature exits, late entries, and constant second-guessing. All of these mistakes share the same root cause. The trader is not fully committed to a single decision framework. Instead of mastering one environment, they are reacting to many. The biggest damage caused by mixing trading styles is not technical, it is psychological. Over time, the trader loses confidence, not because the market is difficult, but because their own decisions feel unstable. When rules change from trade to trade, the brain cannot build trust. One trade is managed aggressively, the next defensively. Results become unpredictable, and the trader no longer knows what a good trade actually feels like. This creates constant second-guessing. Entries are delayed, exits are questioned, and stops are adjusted emotionally. Even when a trade works, confidence does not grow because the process was not clean. Another consequence is emotional fatigue. Switching between styles requires switching mental gears. Fast decisions followed by long waiting periods exhaust attention and discipline. The trader feels tired even on quiet days. This fatigue leads to impulsive behavior. After waiting too long, the trader forces trades. After moving too fast, the trader freezes. Emotional balance is lost because there is no stable rhythm. Routine collapses as well. Each trading style demands a different daily structure, and mixing them destroys consistency. Without routine, discipline becomes willpower-based, and willpower always runs out. Eventually, the trader starts doubting themselves. They believe they lack talent or mindset. In reality, the issue is simpler. They never allowed one style to fully settle into habit. The solution to mixing trading styles is not adding more rules. It is reducing variables. Consistency begins when you choose one primary trading style and accept its limitations. The first step is clarity. Decide how long you want to be in trades, seconds, minutes, hours, or days. This decision aligns time frame, execution speed, and expectations. Next, align analysis with execution. If you're a scalper, decisions must be made and managed on lower time frames. If you're a swing trader, focus must remain on higher time frames, even during pullbacks. Risk must also match the style. Define stop size, position sizing, and frequency specifically for that environment. Do not reuse risk rules from another style. Routine is the final piece. Build your trading day around one style only. Define when you analyze, when you trade, and when you step away. Repetition under the same conditions is what builds confidence. This does not mean you are locked forever. It means you commit long enough for habits to form. Mastery requires staying in one decision environment long enough to understand its behavior deeply. When you stop mixing styles, decisions become simpler. Emotions calm down. Execution improves. You are no longer reacting to the market randomly. You are operating within a clear framework. This is how consistency is rebuilt. Not by doing more, but by doing less with intention. Mixing trading styles is not a lack of effort or intelligence. It is a lack of clarity. When every trade is approached with a different logic, consistency has no chance to form. Real progress begins when you simplify your decisions and commit to one clear framework. Repeating the same type of decision under the same conditions is what builds confidence, discipline, and trust in your own process. As you move forward, keep this in mind. Clarity always comes before performance. Consistency is built by choosing one path and respecting its rules. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include smart money concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, If this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.